Good afternoon, everybody. Thank you for joining
Hello.
us again for another Stocks from Scratch. I'm Brian Feraldi here with my trusty partner, Mr. Stoffel, as always. How are we doing, Stoffel?
Doing very well. I think that the way that these lessons have gone, I feel like we should rename it Stocks That Are Up a Bunch. Why don't we own them yet?
Yeah, for sure. Or AI infrastructure from scratch.
Yep.
Basically, yeah. So if you're joining us live, please say hello in the chat. We'd love to know where you're from. I see Sarasota, Maryland, Austin, London, all over the world as usual. So thank you guys so much for joining us today. Stoffel, let's just start jumping right into it. So we have a fan favorite business today, Coherent,
Whew.
and look at this stock chart for a second here.
We could have gotten in 2 months ago, and I feel like we could retire.
It has been parabolic in the last year, just absolutely gone up. I've been aware of this company forever. I didn't know that it was a kind of a back end play on I didn't know that it was a back end play on AI until I saw the stock kind of taking off. But we are going to be taking this stock through what we're calling the Simplifier 7 framework. So you're going to see us research this company on a fundamental basis from scratch using Stock Simplifier. And Brian, before we get into that, some companies are easy to research, right? Restaurants, retailers. Some companies are middle of the road to research. Some are hard, and some you need a PhD in accounting to really. What would you estimate for this company as in a difficulty level?
So I would put it in somewhere between medium and hard. Like, to me, it'd be right in the middle, because it's gotten into these new areas. Also, I do know this because I used to own a company in this space called IPG Photonics. That was a long time ago.
Me too.
But I do know that this is a combination of a company called, I believe, 26 plus Coherent.
Yep.
So that makes it a little difficult.
There have been acquisitions along the way for sure. So let us know in the chat. Are you a proud owner of this stock? Have you benefited from the parabolic move in this company? Let us know in the chat. While we're waiting for those responses to come in, I'm going to open up Stock Simplifier. COHR is the ticker symbol here, and this is a.
And just while that's coming up, we've got I think we've got 2 people that own the company, a whole bunch that don't. Oh, look at Mark here. He's up 217% after today's pullback.
Not bad. So this is on the New York Stock Exchange in the U.S., information technology, electronic equipment, and components. About a $400 stock. It is paying a dividend.
Teeny tiny.
Teeny tiny dividend. But yeah, look at this move. I mean, if you just go max for a second, look at this. I mean, it was a market beater prior.
Where's that pull down right there? That's March. That's just this March. That's 2 months ago.
No, that's 2026. It says.
Oh, that's okay.
Yeah. So this.
Okay.
Well, I mean, this was April, so it was kind of flat.
That's a year and a couple months ago.
Yeah, exactly. Either way, the move has been absolutely parabolic. And if you bought this stock at IPO, it's a 20% compounder, crushing the S&P 500. But here we go. So their mission is to enable the world to be safer, healthier, closer, and more efficient. Interesting mission statement for it's down 10% today. Wow, 9%
today. Everything in the AI infrastructure stack is down today.
Gotcha. All right. Coherent is the world's largest photonics company, making the laser-based components that connect servers in AI data centers. Making the laser-based components that connect servers and AI data centers. Yeah, talk about being on trend. Cut metal in factories and power electric vehicles. The current
those other two was what the company has been for most of its life.
Used to do. Yeah.
Yeah. Well, and they still do it. It's just that these optics that kind of replace copper, that move information between NVIDIA and Broadcom chips and things like that and make Claude work for us. That's the big story right now.
The current entity was assembled through 3 corporate combinations. 26, that's what you minted, which was founded in 1971. They acquired Finisar, and then the original Coherent, which adopted the Coherent name in 2022. Now, what makes this business unusual is vertical integration. Coherent grows its own crystals, in indium phosphate for lasers, silicon carbide, or power chips. So it makes its own crystals. It fabricates them. It assembles them. And no other company controls this much of the photonic supply chain. NVIDIA signed a multi-year agreement specifically because they build everything from raw crystal to the finished thing under one roof. So NVIDIA signed a deal with them.
Yeah, and I do know NVIDIA signed a deal with two, and I believe Lumentum is the other one.
Yep.
So,
we did that a couple of weeks ago.
Yep, exactly.
Okay, so Coherent sells to 3 distinct buyer types, each with a different purchasing pattern. So these are the customers. So AI data centers, NVIDIA, Google, Amazon, and Meta buy the optical transceivers, by the thousands of connected GPUs clusters. Qualification can take 6 to 12 months per customer, and switching suppliers mid-deployment risks compatibility failure. So there's quite an onboarding ramp here.
Makes sense, right?
I'm hearing switching costs.
Yeah, you're building this into the guts of a data center. It makes sense that there's switching costs.
Number 2, power electronic manufacturers. So companies building drivetrains, data centers, buy the silicon carbide substrates. Only 5 companies in the world make high quality SiC wafers. So these buyers have very few alternatives.
Yep.
And then industrial manufacturers, factories use the fiber and ultrafast for cutting, welding, and micro machining. That was the historic business.
Yeah, like the second and the third is more their core base, but it's the top one,
the old ones, and then this is the new ones. Okay, so revenue by sector: industrial, networking leads at 59% of revenue, up 49% in 1 year on AI data center demand, and materials are 49%. I bet if we break that out, so I'm going to click this button right here and go over to fiscal. And if we go to segments and KPIs, I wonder how they break it out.
There you go. It's under not that one. It's the next one. Kind of networking. No, just down one more. Yeah, right there.
Okay. So networking, materials, lasers. And if we stack these on top of each other, we can kind of see the growth rate. So yeah, this business looked like 2023.
The acquisition is in there too. So that's the tough. That's what makes it tough.
So if we go from 2023 and we look, okay. So
now I will say
here, networking.
If you go down, it looks like they might have rechanged how they do it. If you go down a little bit more to the data, you might need to go. It's weird. It's like they've restated how they do it a couple different times.
They have.
Yeah.
Yeah, for sure. Industrial, electronic. Yeah.
Either way, it's the networking that's driving everything right now.
Yeah, for sure. So networking revenue is growing 20%. So it looked like it had a big jump year over year.
But look at the last one. That's over a year ago. That's over
materials a year ago. Revenue is, this business is declining, the material revenue processing, and then the just laser revenue is also declining. So if it wasn't for networking revenue, the revenue would actually be in decline.
Do you want to do one quick thing? Click on quarterly, because that last read is from over a year ago. Yeah, see, they've done something weird with their reporting here, because even now, the most recent reporting there is almost a year old.
Oh, yeah, you're right.
Yeah. So it makes me wonder. Oh, well, now look at, they've restated it. So we had to go into quarterly, and now they've restated
okay.
it. That's what we're looking for.
Okay. So it's the top line. Is it the top line?
There you go.
Data center revenue. Yeah, that was the problem.
That makes more sense.
Oh yeah, this is quarterly. So they stopped reporting industrial and now report just data center and other. Okay, that makes more sense.
The growth of the green is the thing to focus on.
Yeah, the green here, they didn't break it out this quarter. That's kind of funny. This business is growing 35% per year, but still the traditional one is in decline. Or maybe that's just a reporting issue. There's weird stuff going on with how the company classifies it, but the larger point is revenue is growing and it's due to the AI centers. Let's just pull up revenue in total so we can get a sense of that. Yeah, this is quarterly. So if we go annual and we just back it up, yeah, lumpy, and then boom. I wonder if they sold something here, because it doesn't make sense that there'd be a big decline in revenue there. Either way, that's the business. So North America is 61% of sales, Europe, China, rest of the world, and Japan. So globally diversified. Quality questions. How predictable is revenue? Revenue swung from 5 billion to 4 billion to 5 in 3 years. Tracking hyperscaler spending cycles in the NVIDIA supply agreement adds new forward visibility. So lumpy looking back, more predictable looking forward. We've seen that with many companies. Can the company raise prices? Gross margin improved from 31 to 35% in 1 year, but that came from volume and product mix, not from price increases. I love the details Stock Simplifier gives you on that kind of thing. Hyperscaler buyers negotiate aggressively on transceivers. Okay, so I think that's fair. Modest pricing power. How recession-proof is in this company? Spending provides strong near-term demand, but revenue fell in 2024 as hyperscaler paused, not even during a recession. Yeah, so that seems to be structural.
Well, and it tells you when we get to the risks, I'm assuming there's going to be some serious concentration risks.
Yeah, well, we'll check that out. And what is the competitive position? Dominant. So the NVIDIA had their investment, very strong competitive position. All right, let us know, viewers. Scale 1 to 5. How would you rate Coherent's business? So as a reminder, they make lasers, and they have lots of customers. AI customers are pulling the weight right now. The core businesses seem to be in decline, or at least under pressure. And looking forward, revenue is growing very hugely thanks to the uptick in demand for photonics. What are people saying?
5s and 4s. We've got 1, 3. I know Bob likes to build in a big margin of safety, is my guess. I mean, I look at this and I say a 4 just because of the same thing we come up with every time, which is as long as the party's going, this is going to be amazing. But as soon as the party stops for whatever reason, well, then that's a different story.
We're in party mode right now.
We certainly are.
All right, next question. What phase of the business growth cycle is this company in? There are 5 distinct phases. Stock Simplifier says clearly a phase 4. Top line's expanding, they're profitable, and they're growing, and they're paying a dividend. And they've kind of gone back and forth. A lot of stuff in here with acquisitions kind of throwing that off there. But revenue is growing. Operating profit is positive. No buybacks, paying a dividend with some mixed kind of history there. I think this one's pretty clear cut.
Yeah.
From a phase perspective, if paying a dividend, in capital return. It's very simple. Like that's the easiest sign for their in capital return. So we're not even going to do a poll on that one. All right, next question. Moat, and we break out moat into 2 categories: size and direction. Coherent has a narrow moat from decades of photonics IP and vertical integration, but 5% operating margins show advantages have not become pricing power. So tons of patents. Their vertical integration, but this says customers still hold the powers. Hyperscalers, multi-source transceivers, keeping margins thin at 5%. But the moat is widening. The NVIDIA partnership, the recent inclusion in the S&P 500, the 800G technology leadership widens the gap. So NVIDIA validated the platform. Hasn't NVIDIA made like a whole bunch of billion-dollar investments in companies? That's like nothing.
But 2 in optics players. So Lumentum and Coherent are the big 2.
But they made the same investment in light. Yeah.
Yeah. It's like NVIDIA saying, we know this technology matters, and we also want to make sure that there's more than one player.
Yeah.
And so we're going to give a lot of business to at least these 2.
You do. I mean, a part of me thinks they're making that investment just so that they own stock, so they can say we're the preferred vendor when supply is tight, sell to us.
Yes, absolutely.
And then smaller rivals are falling behind. Knight and IPG lack data center optical capabilities entirely. So let's go and let's check out the company's margins, because that does tell. So if we just look at gross margin here, historically 40s dipped down. This was when acquisition, right? Acquisition and acquisition. So that's probably causing the lumpiest. So
it is cyclical too. Like people remember, typically lasers. That's very cyclical.
If we back it up fully, so the gross margin has been rising basically since they completed the acquisition. I mean, is this pricing power or is this just them getting more efficient from integrating the acquisition?
Yeah.
Hard to really say.
Yeah.
From that's from a gross margin perspective. If we look at operating margin, will we learn anything? Operating margin negative. All right, up to 11%. So, all right. Yeah, hard to make deductions about the company's moat, given that the acquisitions are throwing things off. But let's take a look at each component. Are there switching costs? Moderate. Qualifying a new transceiver supplier takes 6 to 12 months, but hyperscalers deliberately use multiple to avoid dependencies, so lock-in is temporary. Right. So there are switching costs, but the hyperscalers know that and are diversifying. How strong are the brand and IP? Very strong. Decades of combined IP from 3 companies create the industry's deepest patent portfolio. The SiC crystal growth know-how took 50 years to develop and cannot be replicated. Awesome.
Yep, absolutely. And that's super encouraging. It's almost like, Brian, it's almost like what I'm seeing here is that there is a floor and a ceiling. And by a floor, I mean, there's no question this is absolutely necessary for the AI infrastructure build out. And it will be an enormous beneficiary. The ceiling is the people who really hold the keys at this party, which is your NVIDIAs, your hyperscalers. They're saying, that's great, but we're not going to give you all of this. We're going to make sure that there are multiple suppliers so that you don't have the keys, so that we have the keys. Yep. Which is, it's a little bit of both.
Next question. Is there a cost advantage? Vertical integration gives some cost advantage by eliminating middlemen, but Lumentum has similar integration and established SiC competition operating at comparable scale. So they have a cost advantage over upstarts
and non-Lumentum,
but not Lumentum. So Lumentum does seem to be a sizable player in comparison. They own the full supply chain. Networking CapEx nearly tripled to scale production. And Lumentum matches key areas. The primary data center competitor has comparable vertical integration, and the cost gap is real, but not decisive enough to be a primary barrier. All right, so it's there, but Lumentum seems like a legit competitor. And finally, can incumbents copy this? They compete freely in data centers without sacrificing anything, but IPG and Night and Light would need billions in years to pivot to data center receivers. So right now, this does seem to be a two-horse race. All right, time to vote. We need 2 numbers from you. So the first number is, what do you think is the current state of the moat? 1 to 5, the current state of the moat. And then the second number there is the direction of the moat. So if you think it's narrow and widening, you'd put in 3,5. Let us know in the chat what you are saying there. I'm going to look deeply.
I would love to see the bottom part's my favorite, where it just kind of summarizes everything right here.
Yep. So what to watch.
Yeah.
Yep. So after going in, so this is the deep dive feature that's available to pro users, where it goes deep into each of the moat sources. But yeah, the what to watch here. The critical variable is whether the moat widens into something durable as AI infrastructure spending scales. If Coherent maintains or expands its share of data centers during the transition cycles, the intangible assets and switching costs compound with each other. Hyperscalers requalifying for each new speed tier deepens the relationship. Conversely, if the hyperscalers accelerate their in-house optics development, which Google and Amazon are exploring, the qualification costs weaken at the margin for the next generation. That is very interesting. Not all that surprising, though, because
but here's the thing to remember, though. Google and Amazon did the same thing with their tensor chips, their TPUs, and that hasn't killed NVIDIA, right?
Right.
So, but I don't think those dynamics are exactly the same. I don't think this is much a black box as what NVIDIA does.
Fair enough.
Bigger threat is what I mean.
The SiC business is the stronger long-term moat story. The 300 million wafers transition to a multi-year technology lead that only 2 or 3 competitors will be able to attempt. If that becomes the standard, their position create a wide moat in that specific market. All right, what are people saying?
So if I had to average together everything that people said, I would say 3 and 4 is so growing.
That totally makes sense to me. As a reminder for those that don't know, we are using Stock Simplifier to do this analysis. This is a tool that we built. Stock Simplifier. If you want to try Stock Simplifier, it costs about $16 a month for the standard plan. $33 a month if you want the deeper plan that includes the deep analysis and the reverse DCF. However, for our live viewers, we're doing a one-of-a-kind special here. So we're going to give you 10% off the standard plan if you use the link that we have in the chat. That brings the monthly cost to under $15 per month. That is billed annually. And this is something brand new. One of the big requests that we got from people is they want to try Stock Simplifier before they make a commitment. So if you use the link that Stoffel is going to share, you can actually take a 7-day trial with the standard plan of Stock Simplifier. So you'll be billed $0 today. You get access to Stock Simplifier for 7 days. And then if you choose to go forward with the subscription, we'll give you a 10% off for life. In addition, if you choose to do this during the live session, we will throw in Valuation Explained Simply, our premium course on valuation for everybody that becomes a paid member. That is exclusively for people that are watching this live, not the replay. Okay, growth analysis. So this says 5 out of 5, as high as it gets. Revenue grew from $3 billion to almost $6 billion, a 17% CAGR, and that alone added $1 billion in 2025. Nearly all from AI data center demand. Networking surged 49% as the hyperscalers ramp. This is the primary growth engine. Earnings, leverage building, and NVIDIA deal anchors the future. That's a supply agreement through 2030, provides a contracted revenue floor. No wonder why sales have taken off. So 10-year revenue growth of 23%, that's accelerated over the last couple of years. I'm not going to read too much into the earnings story here because, again, acquisitions mess up these numbers really bad. And then high-level questions. Industry. Is the overall industry growing or shrinking? Definitely growing.
This is the no-brainer.
Great industry to be in, right? Fantastic industry to be in. And then can new offerings drive growth? Does this company have the ability to launch new products or new services that drive needle moving revenue? We've already seen that happen just in the last 3 years.
Yeah.
So their new photonics are moving into AI. Definitely useful there. Now, if we go to fiscal and we check out the revenue growth forecast. So over the next 2 years, analysts expect 28% revenue growth. Over the long term, over 5+ years, analysts expect 38% earnings per share growth. And if we go to financials, let's XX and let's pull up revenue. And then can we drag this out? Yeah. So here's what that looks like. Next year, analysts are expecting $7 billion. The year after that, analysts are expecting $9.5 billion in incremental revenue. And I always like to check this too. How is the company doing versus estimates? If you go down, look at the estimates, Stoffel. Yeah,
that green line is the real pretty one.
This is almost like, so we've talked about moat size and moat direction. This is very much the growth historic and growth direction. If analysts are consistently underestimating your revenue, whoa, is that a good sign?
Yeah. One other thing that I think might be worth going into here is if you go to financials and you just pull up segments and KPIs, we might be able to see if there's any backlog numbers. I'd be curious to see, because if they do have that, that's a really great. It looks like they don't. They just have capital expenditures. All right.
Yeah.
It's always
worth checking. Just got it by geography. I don't see a backlog in the other. Nope. That is helpful to see. All right. 1 out of 5, though. If you're watching here, how would you rate Coherent's growth potential. 1, very low. 5, very high. I think I know how people are going to vote, especially considering this is a capital return company that pays a dividend. So the growth drivers here are networking, the materials. Again, the materials business is actually declining. The lasers business is basically at a standstill. So the optionality, this is going to be the interesting part. The most significant growth is the co-packaged optics. Data center optical integrators via pluggable slot. CPO integrates optical components directly into the switch, eliminating the pluggability module entirely. This is a potential architectural shift that could reset competitive positions. Very fascinating.
I mean, that's one of those. So for me, like that, I know that those dynamics mean if they do that, that's a coup, a huge coup.
Yep. Huge.
And
that could
me,
be massive for him.
That also puts it almost like in the too hard pile.
Okay,
for me.
Fair enough. So it just got into the expert category.
Yes, exactly. We've got a bunch of 4s and 5s. I would say the average is closer to a 5.
Yeah. AI agrees, and so do I. Management question. All right. Who is the CEO? And they say this is a great management team. All right. CEO Jim Anderson improved gross margin by 430 basis points, grew revenue 23%, secured a $2 billion NVIDIA investment, and achieved S&P 500 inclusion in under 2 years.
But he hasn't been there long.
Lattice Semiwork tried to connect Anderson transformed Lattice from a growth FPGA into a high margin leader over 6 years. Over 6 years. That must have been the previous one. Strategic clarity from day one. They divested non-core Munich product line. There's the revenue decline.
Mm-hmm.
That explains
there
it.
you go.
So they divested a business and the aerospace subdivisions to focus on AI data center optics. Okay, so even more read into the revenue number here. That's why those historical businesses are declining, which makes sense. This guy Jim Anderson has basically gone all in on AI. Mm-hmm. And NVIDIA validates it. So Carl Johnson founded II-VI in 1971 at age 29. Oh, this is II-VI.
Yeah. Well, so the thing is the real way that this happened was II-VI acquired Coherent and then just renamed it Coherent.
And then became Coherent.
Yeah.
Gotcha. Okay. So he does not own a lot of stock. This does not seem to be a heavily invested CEO. At least but he's only 2 years in, right? So that
makes sense for a company that's this old. It's hard to be that invested.
All right, now let's get into some subcategories of management. So do employees like working here? Now, as a general statement, if a company is acquisitive, and this company has been acquisitive, that's how it's been built, I always expect horrible Glassdoor reviews.
Mm-hmm.
If you've ever been a part of a corporate buyout, you know how stressful it is. People get longtime employees get shown the door. It is horrible. And that is the time that people go online and just complain. So this is Glassdoor as a 3.4 out of 5 with 50% recommending, but cite merger integration pain. Yeah, there you go. That just comes with the territory, but they have good benefits and employee stock purchase plan. I bet they're happier now if they kept their stock.
Mm-hmm.
Do they beat expectations? They've beat estimates in 8 of the last 8 quarters over 2 years, and EPS more than doubled to $1.29 per share. So they are executing very well now. Is management shareholder friendly? The diluted shares grew 35%, but that's due to acquisitions and NVIDIA.
Yeah.
There's no buyback program. They're prioritizing debt pay down, which is the right call right now. Great. So they're paying down debt, probably due to the acquisitions, I'm guessing. And is management earning a good return on capital? It's bounced around. Yeah, this number is going to.
Well, with all the acquisitions, it's like, how do you even trust those numbers as a steady state, meaning anything looking forward?
Totally. Acquisitions just mess up financial statements. They just mess them up. So things like return on invested capital become much harder to analyze here. So management quality is high. He became CEO, succeeding Chuck Matera, who retired. He worked for
Intel, Broadcom, AMD, and Lattice. He's been at all the big players.
He's transitioned the company. He was at Coherent, etc. Do they like it? So here's a chart that shows them versus estimates. Really good, really consistent. 8 for 8. And then what to watch. All right. What do you guys think of this management team? Early on, scale of 1 to 5, poor to awesome, based on what we've seen thus far. Let us know in the chat. So Anderson has been in the role for less than 2 years. We saw that. Employee sent to me is low, and free cash flow margin is the thing to track him on. So free cash flow margin is up to 5%. Actually, let's check that. If we go to cash flow statement and let's check out free cash flow. Oh, this is going to be negative. Yeah. Investment. They're in investment road right now.
Well, they said they're expanding their capacity, right? That's the right thing to do.
Absolutely. That is a good use of investment dollars right now.
I would say the average of our replies, and we got a bunch of them, would be a 4.
Okay. 4. I agree with that because while he's done a good job, he's only been there 2 years.
Yeah.
So hard to know.
And does not own a ton.
Okay. Risk time, execution risk. So again, this category only looks at the business risk. We are not looking at valuation risk. That comes next. The heaviest risk is the 3.5 billion in debt with only 1.5x interest coverage. Explain what that means, Stoffel.
1.5x interest coverage just means that they have to spend a whole bunch of what they get coming in on the interest. I mean, that's a trap that you get into. It's like if you ended up spending half of your income just paying off your mortgage. That's not sustainable.
Right. So operating income. Yeah, where's interest expense? Interest expense is right here. Yep.
So look, $650 million in profit, but then you have to ship off over 40% of it to pay that interest.
Now the interest expense is going down, which is because of the debt repayment, which is why they're not buying back stock. That is the correct thing to do, but that is a financial risk to keep in mind. So the interest coverage is not that high, and that would be a huge problem if this company was cyclical. Revenue.
It is cyclical. Looking backwards.
Looking backwards.
Yep. Now the big question is, will it be cyclical moving forwards? That's the $1 trillion question.
Hyperscaler dependence is very high, and 3 company integration ongoing. So culture,
30
concentration, and financial risk. So communication is 59% of revenue, 3 product segments, and 5 geographies. Okay. Curious if this calls out any individual company. It does.
I'm checking the most recent annual report just to see, but it does not look like it. It does not call out any specific customer concentration.
So we've programmed Stock Simplifier to look for any customers that are over 10% of revenue. So this says no, there's no customers that over, but even though they're not reported as over 10% of revenue, there is some concentration issue here to just keep an eye on, which makes total sense. That's better than I thought it was going to be. Is disruption a threat? Co-packaged optics could eliminate the pluggable transceiver form factor where Coherent currently leads. And then
didn't they say that it could be the one that provides that, though?
It could also be the one that provides that. Yep. But the bigger disruptive threat is the in-house people doing it themselves.
Yep. And it's important to note, just real quick, it's important to note that if you're an investor, it's not like you'll start losing money in your stocks the moment that Google or Amazon starts using its own optics. That's not how it works.
Nope.
You will start losing money once it becomes clear enough to other investors that Google and Amazon might 5 years from now have their own optics. That's when you pay the price, which is why this can be so tricky.
Market prices are disrupted way before you actually see it in the numbers. Yep. Right. It's been called market trauma happens way before business trauma. Mm-hmm. So if a news release came out that these companies could do it themselves, the valuation here would get crushed.
And it works both ways. Market growth happens way before real life growth.
Morgan Housel has said it best. A stock price today is a number from today times a story about tomorrow. That story about tomorrow can change in a heartbeat. How much is outside of their control? The U.S.-China relationships are 12% of revenue. Tariffs, the global supply chain, and AI spending. Yep, all fair. And then finally, how healthy are the financials? Low interest coverage, high levels of debt, and the margin for error is thin. So they are paying down debt. They use the NVIDIA investment to pay down debt. So the direction is positive, but they're still skating on modestly thin ice here. All right, let us know. What do you think about the riskiness of Coherent, the business? Moderate revenue concentration, moderate threat disruption, moderate outside forces, and weak financials overall. This is going to be a very interesting one to see how people rate the riskiness.
Now, to be clear, a 5 is like very, very low. Okay.
Yes.
A 1 is this is really risky. Just making sure that that's clear.
The numbers are reversed, right?
Yeah. Basically, we want good on the right, bad on the
5
left.
is always good. 1 is always bad. So yeah.
You know, I'm a little surprised. I would say the average here is probably a 2.
I think it's average of 2, and I would say I'd say that's spot on.
Which one of those worries you the most of those threats?
I think the financial one, there at least management is focused on the correct thing, right? Mm-hmm. The revenue being diversified, I don't think that's going to be a threat for the next, like, just call it 2 years, right? The AI demand is so high. The disruption thing, the outside of the control, that's kind of always been the way. I guess the disruption, the internal disruption, customers
like Google and Amazon building in-house. Yeah.
Google and Amazon building it own in-house. But as we saw from the moat perspective, this company has 50 years of vertical integration. So, but if you force me to choose, I would say disruption.
But the big thing that's tough is that big players just didn't have motivation. There was no incentive for huge global players to develop their own photonics up until now. And so the question is the moat that they built because it is truly super difficult to do? Mm-hmm. Or is the moat that they built just because it was a niche that didn't incentivize big players to put their resources behind it? And then once they do, they solve it quickly. Again, this is why for me, it's just in that too hard pile because I don't know.
It's hard. It's just a hard business to analyze. By the way, we are using Stock Simplifier to do all this analysis and a combination of fiscal. So Stock Simplifier is normally $16 a month, but thanks to the live stream, we are doing a promotion. 10% off the $16 a month plan. It's just going to be $15 per month. And we are offering a 7-day free trial. So if you use the link that Stoffel is sharing, you can try Stock Simplifier for 7 days for free. And if you do decide to become a paying customer 7 days from now, if you try it and like it, we will give you access to Valuation Explained Simply, our premium course included in that. All right, so we'll keep this at high. Next is valuation. Whew. This should be interesting. So AI says very expensive. Coherent's current PE of 186 is significantly above its 5-year average of 81 and the upper band of 146, indicating a very expensive valuation relative to its earnings history. So it's high. The dividend yield is normally about 0.25%. It's currently 0.3. The company's PE ratio is way higher than that. And the valuation suggests a stock is currently trading at a premium, making it potentially risky. So we give you one number by default. This is the best number to look at. And this changes depending on the phase that the company is in. So this company traded for about 20 times earnings for several years, made the acquisition, made the pivot, currently at 185 times earnings. We do give you some other things to look at. So price to free cash flow, this is basically infinity because free cash flow is negative. Price to operating free cash flow, 600 times price to operating cash flow. This number used to be in the single digits or teens. The dividend yield has gone in the wrong direction. Shareholder yield has gone in the wrong direction. Price to book, trading about 7 times book. Price to sales, 12 times sales. Historically, this company was 2 times sales. Price to gross profit, 30 times sales.
A couple of things worth doing. If you could go to fiscal and pull up forward PE. I think forward
Yep.
PE ratio is probably the best.
Okay.
Because free cash flow is not great because they're reinvesting in their capabilities, their manufacturing capabilities. And I think when you look at that, you might be surprised at what you see.
All right. So forward price to earnings ratio, currently 57 times forward earnings.
That's not terrible. Like, that's not obscene to me. It's not cheap, but it's not obscene.
Historically, this number was 25. It got as low as 11, currently 57. And this number does factor in, as Stoffel is saying, forward growth, which is an important caveat. When the numbers are changing rapidly, looking forward does make sense. So 57 times forward earnings. The other thing, well, we can't even do a reverse DCF because we have no free cash flow.
Well, for what it's worth, I've done an optimized one, which is, if you want to pull up on Fiscal their free cash flow margins, you'll see that I'm making a stretch here because I think that that's really important to show. So what I did was,
well, let me pull up the margin first just so we can see. So if we go to margins and we go to free cash flow margin, so this number is bounced around. So it's currently negative 8% free cash flow margin, but it got as high as 14. So what are you using?
So if I gave it a 12%, now I did that because I said, there's so many different things and it's so far away from 12% right now. You know what I mean? It's at -8. So if I give it 12% and I gave it a 3% terminal, a 10% discount rate, then it needs to grow its revenue by about 29% per year for a decade. Now, estimates are for 35% growth over the next 2 years. That's above 29. So in general, that looks, you got to hit those margins. You got to hit it. But, 35 is above 29. That's great. But guess what? That's only for 2 more years. You've got to maintain an average 29% growth rate for years 3 through 10. And that's the part where we come to the same conclusion, Brian, every time we do one of these companies. And the conclusion is this: where are we on this S curve of the AI infrastructure build out? Because if we're right here, well, then this might be a cheap stock. But if we're right here, then we're October 1999, and we'll only know looking back.
So again, let's talk about what you just did. So this is the historic free cash flow margin for the business, which is all over the map, just all over the map. What you did was say, well, I'm going to assume that the company's free cash flow margin is 12%, which is below the peak. I think
it's generous as a constant.
Fair enough. That could be that is generous as a constant. In fact, one way to do it might be just what is the average? The average is 7.
Yeah, so I gave them double. Not double.
You gave them double. So you doubled their free cash flow margin. And then you said, if they were at that doubled free cash flow margin today, how fast would they have to grow revenue over the next 10 years for today's stock price of $393 to make sense and deliver what kind of return? 10%?
10%. Market matching.
So if you're buying this stock today, the company has to get its free cash flow margin to 12% and grow revenue 29% for 10 years for today's price for you to earn a 10% return going forward, with the enormous caveat being that fundamental analysis and that this company is being valued on its free cash flow in the future. Because right now I'd argue it's being valued on its momentum, in which case a lot of the investors that are in control of this stock right now don't care about reverse DCFs. All right. Well, with all that in mind, what do you think, viewer? How would you rate Coherent's valuation today? A 1 would be extraordinarily expensive. A 5 would be very attractively priced. 3 would be fair value, etc. Here's a good point by Bob.
Yep.
So Bob says the entire market is going to grow 23 to 26% over the next 10 years. So they might just be, they're in a fabulous market, right? And if you think that the moat can hold over the next 10 years and they that doesn't require Herculean level market share gains for
Mhm.
them to achieve that revenue target. Thank you, Bob. That was very helpful context.
Yeah, totally.
Yep.
I would say on average we got ones. I would probably give it a 1 or a 2. That forward PE ratio of
59.
in the 50s is not terrible. And the other thing that I will just say is that I can see a world where they do average 29% growth. Now,
Mm-hmm.
everything needs to go right. Everything needs to go right. But
Yep.
I could see it.
I also agree. I don't think it's out of the realm of possibility given the industry that they're in. And we don't know how long the AI spending boom cycle is going to be. Is it a boom? Is it a new normal? That remains the question. But to summarize everything we've learned, we gave this business a 4 out of 5 on the awesomeness quality scale. We said the phase was phase 4 capital return. We gave the current moat a 3 out of 5 rating, but importantly, the moat is widening. We gave it a 4 out of 5 in the widening. The growth over the near term and, as Bob pointed out, over the long term looks fantastic. The management team has only 2 years of tenure, but even in that 2 years has done a fabulous job. Just fabulous, regardless of what the ratings say. The business risk here is 2 out of 5, quite high. And the valuation, depending on how you slice it, is either extremely expensive or just expensive, depending on which lens that you look through. This is to me is a classic business to put on my watch list. I'm not going to pay any price for it, but I am glad we researched this company because it clearly has a lot going for it. And I understand why the market is excited about this.
Totally.
Yeah, I understand.
I think that again, for me, this is just it's a too hard pile, and it's okay. There's no called strikes in investing.
So Stoffel, if you were going to invest in this company, what do you think are the 3 metrics or 3 things to watch from here?
Well, I think that the first thing that I would need to watch is just the revenue growth rate. I mean, that's got to be number 1. The second thing would be whether or not they can start improving those free cash flow margins. Now, I would be okay with it taking a while to get there because of the infrastructure build out. So I would also be watching the gross margins as an indicator that the moat is widening. And then the third thing is really just keeping an eye on the AI infrastructure market writ large, right? Because right now, every company should always be judged based on their own individual fundamentals. But let's be honest, what's going to move this right now is what the AI infrastructure stack is doing. That's going to be what creates most of your alpha or most of your returns or losses over the next 12 months, probably.
Totally fair. If you look at the market that we are in today, if you're a part of the AI supply chain, wow, has 2026 been fabulous. If you're not, wow, has 2026 been mediocre at best, right?
Yep.
There's a lot of companies that have not participated in the overall rally from what it is. So as a reminder, if you are interested in Stock Simplifier, it is $16 a month or $33 a month, depending on if you want the standard plan or the pro plan. The pro plan comes with the deep analysis and the reverse DCF. For this webinar replay, we are offering a 10% discount, less than $15 a month, to access Stock Simplifier. Stoffel, if you could share the link. And if you use the link that is pinned below on whatever platform you're on, you will get a 7-day trial of Stock Simplifier. So you can use it for 7 days absolutely free and choose if you want to keep it after that. If you do choose to keep it, we will include that 10% off coupon in your order. And this is only for people watching us live. If you order it live while we're on, we will throw in Valuation Explained Simply. Our course on valuation will be included with your offer.
For what it's worth, I've oftentimes said that what Stock Simplifier really is it would be like hiring a recent college graduate and saying, go research this company, take all day to do it. And then at the end of the day, come back with your report. And it's a great way to vet ideas, get an idea for where a company is, really understand what's happening. Probably we don't think you should automatically make an investment decision based just on this, but I would have to pay a person like that a whole bunch. And just doing the math on what you just said, if you run 20 in a month and you're paying $15, you're getting each one of these reports for less than $1.
Both you and I have been using AI to research stocks for almost 2 years now. Stock Simplifier makes it systematized, keeps everything organized. It asks a consistent number of questions, and critically, it keeps a dashboard for you of all your companies in your research. So we just showed you how quickly you can do it. But to me, the dashboard and tracking the companies is the real thing that keeps it so valuable. So if you're using AI, we love using AI, but we think that Stock Simplifier gives you the best of both worlds. It's software plus the AI powering it. Either way, thank you guys so much for joining us today. We super appreciate your time and attention. We will be back next week to do another Stocks from Scratch. We hope that you guys join us then. Bye, everyone.
Bye.